price rising would entice more silver into London, and then they'd be able to sell it short at a higher price. But if the silver isn't there, then they can't sell short, and therefore the price would rise. I don't think there's a whole bunch of naked shorts and that bullion banks just dump paper on the market to save the monetary system or something like that, or that they have the power to do that. And a lot of the more conspiratorial gold and silver bugs get stuck in this mentality that the bullion banks control everything. It black pills people. The bullion banks control everything, and they can just dump whenever they want. And the gold and silver bugs will never win, and the dollar will keep ripping us off forever because the bullion banks are just so powerful, and they can put gold and silver prices wherever they feel like. I think that's a very damaging mentality.
The spot price might be $4,000, $5,000, but to actually put metal in your hand is $20,000, $30,000.
The silver in London really is being claimed by 4, 5, 6 people each bar, which if you could show me evidence of that, I'd say fine, you're right. But I haven't seen it. So let's say JP Morgan is selling gold at 5,000 an ounce. What I think is happening.
Okay. That looks a little exponential. Is that the middle one, the open interest in the volume?
No, at most it's like arithmetic. Right? It's this is volume. This is volume. The middle is open interest.
Okay.
Right? Open interest has been pretty steady since 2005, right? For about 20 years. It hasn't really gone on net anywhere.
Well, look at the price from that same period. I mean, except for recently. So maybe it's about to slingshot higher. I don't know.
Okay, so we have that, and
That looks it looks a little exponential.
No. Exponential would be a lot crazier. Like in the late 1970s, early 1980s, the first major gold bull market. We have open interest here of about, let's say, 200,000. When things get really picked up. And this is when price is rising here in the 70s and open interest is going up, right? Yeah. And then we have open interest is steady. Open interest is steady, where if your theory is correct, then open interest being steady would mean that the price goes up. But open interest is pretty steady here from 1980 to 2003, right? And the price pretty much goes very little. Doesn't move much.
That would only be correct in a ceteris paribus, right? And there could be other market forces that were suppressing the price as well.
Open interest stayed flat for 20 years while gold quietly doubled, and that contradiction should bother you. Rafi Farber points out that since 2005, open interest hasn't meaningfully expanded, yet price behavior recently hints at acceleration, not stagnation. That breaks the lazy assumption that futures growth drives price alone. The real question is what suppressed price from 1980 to 2003 despite steady positioning. For long-term holders, this suggests hidden macro forces can delay but not cancel price discovery cycles. Next, Rafi Farber reveals what this suppressed phase historically precedes and why timing now matters.
So I don't necessarily say that it must go up. But not shorting it would, or not issuing futures contracts would have a positive effect, but it might be overwhelmed by extraneous negative effects.
Yeah, I just think they're using the contracts and backing them with physical in London or wherever they're getting it from, and just profiting off the spread. That's what I think is happening. And there was one other chart I wanted to show you here. It was in silver. Okay, yeah. So I'm going to go to silver.
So actually, we can wait till after the graph. I was just going to ask what games you think are being played, because you think there are some games being played.
Yeah, I think they're minor. Like spoofing what the banks do when they put in orders that they intentionally do not fill. Like they put it on a time.
Why is gold not like $50,000 an ounce right now? Like something's keeping the price of gold down from where we think it is going to be.
The fact that everyone is tied to the dollar and they can't escape it until it goes to zero.
Okay. So it's just the credit system. Okay.
Yeah. Okay. So here you see the interaction between, let's put it on a 20-year chart, between silver open interest and the price, right? So this kind of could be interpreted in terms of your theory, right? Open interest in the green goes up in silver and the price goes down, right? From 2011, right? until 2020, this bottom over here, and you have price going down from 50 to about 11, and open interest over that time trending higher and higher from about 100,000 to 250,000. Okay, so that would anecdotally fit with what you're saying. And then from here at the top of 250,000 right before the lockdowns, open interest starts trending down. Now we're at 100,000, right? We just broke 100,000 today. We're at 99,000, and the price goes up as open interest goes down. So you could say, fine, that anecdotally fits in both directions. However, you have this here from 2008 to 2011, where open interest is going up from 85,000 to 160,000, and the price is going up from about $8 to $50. So that doesn't fit. You could say, well, that's in spite. Maybe it's in spite. But here's my theory and why I think it fits with all this. So I think there's a certain amount of silver in London. It goes up and down, right? It doesn't just stay there. So the more silver that exists, the more futures contracts can be sold against it, according to their regulations or whatever they have to do.
Silver's open interest hit 250,000 at the 2020 peak, then collapsed below 100,000 while price climbed. That timing shift isn't random. According to Rafi Farber, this inverse relationship flips depending on physical availability, not just paper positioning. The 2011 to 2020 period shows rising contracts alongside falling price, but earlier cycles completely contradict that pattern. That inconsistency signals a regime change, not a stable model. For investors, this means relying on one metric could blindside you during transitions. Next, Rafi Farber exposes what drives these regime shifts and why London supply is the hidden trigger.
If the bullion banks have to cover, because they're spread traders, they're not speculators, if they have to cover every silver short contract that they sell with physical silver in London, then the more silver that exists in London, the more they can sell short, and open interest will go up. And now, if the supply of silver in London is really going down, and there really is a problem with the supply, which I hear rumors of that, I can't really substantiate it, so I haven't opened up the vaults, I don't know what the hell is there. But if the supply is going down and they can't sell as many contracts short, then they can't sell them short. They have to wait for the price to rise to be able to sell it short, because the price rising would entice more silver into London, and then they'd be able to sell it short at a higher price. But if the silver isn't there, then they can't sell short, and therefore the price would rise. That's what I think.
No, I think I like I said, I'm not entirely wedded to the idea that, and it's not required that this scam exists to have us enslaved into this debt system for so long.
Yeah, continue. I'm sorry. Yeah.
Oh, I mean, your argument's pretty persuasive. Maybe there isn't any games going on under the scenes, but maybe there is. I don't know.
I think there.
If London vault supply keeps tightening for another quarter, price suppression breaks, and late buyers pay the price. Rafi Farber's analysis suggests open interest expansion is constrained by physical backing, not just speculative demand. That flips the common belief that banks can endlessly short metals without consequence. If supply shrinks, they can't issue contracts freely, forcing price higher to attract inventory. For holders of physical silver, this creates asymmetric upside, but for paper traders, it risks sudden repricing gaps. Next, Rafi Farber reveals what happens when physical scarcity collides with paper promises.
I think there are minor gains, but I don't think there's like a major... I don't think there's a whole bunch of naked shorts and that bullion banks just dump paper on the market to save the monetary system or something like that, or that they have the power to do that. Even if you're going to take a less maximalist view. But what I think is important is not to get stuck in the mentality, and a lot of the more conspiratorial gold and silver bugs get stuck in this mentality that the bullion banks control everything and black pills people. The bullion banks control everything, and they can just dump whenever they want, and you know, the gold and silver bugs will never win, and the dollar will keep ripping us off forever because the bullion banks are just so powerful, and they can put gold and silver prices wherever they feel like. I think that's a very damaging mentality, and it'll just drain you. And I don't have that mentality at all.
Yeah, if they will at some point. If my theory is correct, they will at some point. Either the markets will fail, like people will say, well, someone will say we need the silver that can actually open the vaults and can't be turned away, and it turns out there's the vaults are empty. And
the narrative says bullion banks control everything, yet market history repeatedly breaks that illusion. What Rafi Farber is signaling here is that while minor tactics like spoofing exist, total price control would require infinite balance sheets and zero risk. Neither exists. That contradiction exposes a psychological trap. Believing manipulation is absolute keeps investors passive. In reality, structural failures emerge when physical demand overwhelms paper systems. For long-term holders, this means volatility isn't suppression, it's pressure building. Next, Rafi Farber unravels the exact moment when that pressure forces markets to break.
In that case, the market collapses, or the vaults, the market never fails, but people just walk away from it. The physical premiums would just skyrocket to infinity. So the spot price might be $4,000, $5,000, but to actually put metal in your hand is $20,000, $30,000. So either way, their power is.
I think that's going to happen. That's probably going to. I mean, look what's happening in oil once once Hormuz was blocked. You have the spot price of Brent being like $30 or $40 more expensive than the future.
But doesn't that show a paper? Isn't that evidence of a paper game?
I don't think it's evidence of a game. I think it's evidence of somebody like a trader, again, and the owner of a tanker was trying to pocket the spread between what he would spend on the oil in Hormuz and what he would sell it for in Argentina or wherever he's shipping it to. And then he can't ship the oil, so he has to close out. So he has to close out the oil that he can no longer ship out of Hormuz and sell it. But he can't sell it for a profit because nobody wants it because he can't get it out of Hormuz. And therefore, then he's got to buy back the contract in Argentina that he sold for like really, really high because they need oil there and they don't have it. So you have this like wild price differential that just like warps itself once the oil can't leave Hormuz. And then you have this crazy backwardation. And then because Argentina is like begging for oil right now, because this guy can't sell it to them, and so the price of their contract goes way, way up, and then you have this pocket, this big space between spot and futures. And
okay, so it's not necessarily a game. It's just the existing contracts are not able to be satisfied. Okay.
Right. Right. So
Okay.
sort of like when silver went to 120, it wasn't like the coin shop owners were like, "Whoa, it's too expensive. I'm not going to sell. I want to keep my whole stash because the dollars." It's not that. It's that they can't hedge because the price is going so wild that they can't figure out what they're supposed to sell this for, and everything shuts down. It's just the way the system works is that it will shut down when things start going haywire, and that's what's going to happen with gold and silver.
Brent spot traded $30 to $40 above futures during the Hormuz disruption, and that spread tells you more than headlines ever will. Rafi Farber highlights that this isn't manipulation. It's a breakdown in contract fulfillment when physical delivery fails. The same mechanism can hit silver, where spot and physical premiums diverge violently under stress. Institutions don't warn about this because it exposes system fragility. For investors, that means paper pricing can become irrelevant overnight. Next, Rafi Farber exposes why futures markets fail precisely when you need them most.
And it could resemble, a default that you can't deliver. But I don't think it's because nothing was covered, unless the silver in London really is being claimed by 4, 5, 6 people each bar. Which, if you could show me evidence of that, I'd say, fine, you're right. But I haven't seen it.
Yeah, it's above your and my pay grade. Okay.
So when they're selling those contracts, right, for every seller, there's a buyer. So let's say JP Morgan is selling gold at 5,000 an ounce, right? They sell that contract. Let's say they sell that contract for 5,000 an ounce, and now they have to deliver that, or close it out. So okay,
not yet. I'm going to get to that.
Then they sell another one, and another one, and another one, and then. But as they're selling it, before they get a buyer, the price they have to find a price where there's going to be a buyer. So it's not like they sell 1,000 contracts at $5,000 and then all of a sudden the price moves. They're profitable on all those contracts that they sold, and then it doesn't work that way.
Everyone assumes banks can dump unlimited contracts without consequence. But market mechanics make that far riskier than advertised. Rafi Farber highlights that every future sale must find a buyer in real time, meaning price adjusts instantly with each contract, not after the fact. That destroys the illusion of delayed manipulation or guaranteed profit stacking. If anything, aggressive selling exposes banks to immediate pricing pressure and execution risk. For investors, this means volatility reflects active negotiation, not scripted control. Next, Rafi Farber reveals why this real-time pricing dynamic limits manipulation more than people realize.
Let's say they sell one at 5,000. It goes and then they're trying to sell a second one. It goes and then they only find a buyer at 49.95, and then they sell a third one. They only find one at 49.90. So they have one they sold at 5,000, one they sold at 49.95, one they sold at 49.90, and then in order to win on those contracts, it has to keep going down below what they sold for the last one. You see what I'm saying?
So you're saying it's because they're selling so many contracts, it's moving the actual price. It's like the price of the market is changing as well. Like
yeah, there's no delay. It's the actual offering of the contract in the market that is going to have to find a buyer at a certain price, and that's what's going to move the price. So they're risking a lot of money. It's not like they can sell 1,000 at $5,000 and then there's going to be like a 6-day delay until the price falls because of those 1,000 contracts that we just sold.
The same cascading pricing effect showed up before past commodity squeezes, and it always starts with marginal buyers stepping back. According to Rafi Farber, each incremental contract sale forces a lower clearing price, meaning the market reprices continuously, not in batches. That creates a fragile ladder where one missed bid can accelerate downside or trigger reversals. Historically, these sequences precede sharp volatility spikes within weeks. For traders, that means timing risk isn't theoretical, it's embedded in execution. Next, Rafi Farber walks through when this pricing ladder breaks and how fast it can unwind.
I don't think it works that way.
So I'm not sure. I'm not sure if this ruins my plan or not, or my explanation. Let me continue as if you didn't say all that stuff.
Okay, fine.
You can interrupt me. So I think they're selling, like I said, I think they're selling the contracts, and that shifts the supply out, driving the price down. Now maybe that, like you said, maybe they're not selling them all at the same price, and then it like goes down like this. Maybe they're riding it down and they're having to sell more contracts, and that those final contracts at the end are very much marginal profit makers, because what they're doing at the same time is shorting. So as they increase these as they issue these contracts, they start shorting them as well. Now they're making, someone has to take the other side of that short as well. For every short there's a long, just like for every buyer of the contract there's a seller. I'm assuming the market is there to meet those needs. What would happen is that people will stand, the short is profitable, right?
If contract issuance keeps accelerating while prices drift lower, retail portfolios absorb the volatility long before institutions feel pain. Rafi Farber's analysis suggests supply expansion through futures doesn't just reflect demand. It actively reshapes price discovery in real time. But the overlooked risk is that late-stage contracts generate diminishing returns, increasing exposure while reducing margin for error. That's where institutional players hedge and exit, leaving retail holding unstable positions. For long-term holders, this phase often precedes violent reversals. Next, Rafi Farber exposes why late cycle shorting becomes a liability, not an advantage.
So they use, let's say the price goes down and the market is intimidated, successfully intimidated. The price of silver goes down for a bit, and you collect the profits on the short, and you use that to pay off the futures contract, and then spread the difference.
That sounds convenient, but it sounds too simple to work. All you would need is a whole bunch of capital, and there's a lot of billionaires that have a bunch of capital. That's all you have to do to have guaranteed profit every time. Oh, until the system collapses.
Until the system collapses.
Yeah, but I don't think that's possible, and I don't even think that's what's happening. Here's my well, look, I don't have enough evidence to prove what I'm saying is right or to prove what you're saying is wrong. I'm just trying to think of what makes more sense.
But what here's well here I think there's something we might be able to test later. Let me go in the other. So let me continue on. But you may have noticed the price of silver has been going up as of late. So the question is, did the short get a lot of people? Were the people shorting? Did they get caught with their pants down?
I'm desperate, Mr. Valiant. Can't you see how much I need you?
Dabbling in watercolors, Eddie?
And so what would happen if you lost this bet? Let's say you did you issued 1,000 contracts for gold, and then you shorted it, and then the price went up anyway.
Well,
Now
issuing the contracts is the shorting.
No, the futures contract is not a short.
If you sell a futures contract, you're selling it short.
Is that so?
Yeah.
I thought a short was a separate. But you could make a separate bet that the price is going to go down.
Yeah, but that's just leveraging the bet that you already made.
Okay, so you can do a leverage. Maybe I'm thinking of a leverage short rather. What I was trying to describe was a leverage short then. But even just selling the futures contract. All right, so let's say you issue the futures contract, but for whatever reason the price goes up anyway, right?
If shorting silver were guaranteed profit, institutional capital would have already eliminated the opportunity, but it hasn't. Rafi Farber points out that the easy money theory collapses under real market conditions, where rising prices can trap shorts and force costly reversals. That contradiction exposes a deeper truth. Markets are competitive systems, not exploitable loopholes. When price rises against heavy short positioning, it signals stress beneath the surface. For investors, that's often the early stage of a squeeze dynamic. Next, Rafi Farber exposes how trapped shorts can accelerate upside far beyond expectations.
The market overwhelms your attempt to manipulate it. Now you're on the hook, right? Because now you have to cover the short at higher prices and show up with the actual gold. So what does a bullion bank do in that situation? It will, since it can issue all these naked shorts, it'll just double down and keep issuing more shorts. So what I would expect to see is an exponential growth in the futures market. If my theory is correct, I would expect to see exponential growth in the number of futures contracts. Because they get it wrong a lot too. They get it wrong maybe even more than they get it right.
There is an exponential growth in the futures.
There
market.
Is not?
No, not that I can see.
Oh, then maybe I'm wrong. Okay.
No, the selling short of the contracts, if it's not covered, that is selling short. It's literally selling the contract short because that you have to deliver it now, right? That's the short selling.
Yeah, that's true. Okay.
So
you could leverage that too, but fine.
So I mean, even J.P. Morgan has a brokerage and they're subject to margin calls too. It's all just a ring of margins.
The theory says banks can endlessly double down on shorts, but the data refuses to show exponential growth in futures positioning. What Rafi Farber is revealing here is a critical contradiction. If manipulation were dominant, contract volume would explode as banks defend losing trades. Instead, we see limits, suggesting capital constraints and real risk exposure. That breaks the narrative of infinite control and replaces it with bounded influence. For investors, this means price surges can overwhelm even large players.